Hi, I'm Ozzie Jurock. I'm the host of OZZIE'S, where we interview interesting people and their journey to success. Today, I'm very pleased to welcome Justin Smith, who is the president of Hawkeye Wealth, a company that specializes in wealth generation through investment in real estate. Hi, Justin.
Hello, Ozzie. How you doing?
Really good. I'm glad you made it.
Thank you for having me.
So your journey has been kind of an interesting. Did you go straight into the investment business?
Certainly not. I've always enjoyed investing ever since I was the teenager. The concept of compound interest, of course.
Really, as a teenager?
Yeah, I was pretty fortunate that way, I suppose, to have gotten onto it at an early age. I actually did my undergrad in psychology. I thought I was going to get into
Interesting.
And then third year comes around and they start getting into the really goofy stuff, and you think maybe I don't want to deal with this every day. And so after I realized I didn't want to do that, I finished up my degree and did my master's in business, my MBA here in town. And shortly after, my landlord, in fact, introduced me to your conference. That's how I got into real estate, Ozzie, many years ago. And he was a very successful man, really looked up to him and was doing very well for himself. And I just couldn't believe it when I walked into your conference that I think you had 600-700 people there. I was just blown away that the topic could attract that many people. So met some very key contacts there, and that really changed the trajectory of my life, where I started getting into real estate.
Yeah, and then you started out in the sales area of things and learned a bit.
Yeah. Started out working with a developer selling pre-sales, and of course you go through the classic. Anytime you get into a job where you're 100% commission, or you go through the classic struggle that most people go through, and you realize that you
only eat what you kill.
It's you have to get results, and if you don't, you make $0, and that comes with all the wonderful stresses of life, from pressures you have on yourself, pressures your spouse has on you to get it together. So I got started doing that, and after a lot of pain, started having success, started thinking I was pretty smart, and after a year or two of making some good money doing that, I realized that I wasn't that smart, that everyone that was actually buying and owning the real estate was making a lot more money than I was. So fortunately I was in a position to start building my own portfolio, and thankfully I'm in a business where I can help other people do the same. So
is that what made you decide to get into the investment business, is seeing other people being successful?
Yeah, I mean it's a big part. I mean, first of all, I like investing myself, and second of all, I had the opportunity to help others go and grow their portfolios, and I've done that in different capacities. As I said, I started doing pre-sales here, and now I'm working a little bit more doing private equity real estate deals, but it's all ultimately real estate that I've done for the last decade.
So is that what Hawkeye Wealth is all about then? Is that what you do?
You got it. The technical term for Hawkeye Wealth is an exempt market dealer, but where we focus is on private equity real estate, primarily commercial real estate. So this is going to be your commercial real estate entails industrial, retail, multifamily, and office. We focus more specifically on multifamily and industrial. These are the two asset classes that we're more focused on. And then we go and we find opportunities out there, and we introduce them to our investors. So we're actually in I don't call it the matchmaking business here, but that's pretty much what we are. We find opportunity and we connect it with our investors.
You had a choice. So at the time, I think you could have just joined another investment exempt dealer, but you chose to open your own company.
Yeah, for me, a couple of years back, I had an opportunity to either go and when you're an exempt market dealership, you can, like you say, you can either go join somebody else's firm or you can set up your own shop. And I can tell you, especially in the short term, it would have been a lot less work to go and join someone else's firm. And there's a few reasons that I decided to go and do my own thing, and it really revolves around what the biggest risk of my business is, which is losing trust. It takes, and as you know, Ozzie, you've been in the business now for many decades, it takes a long time to build trust at scale. Yeah. And anything that could jeopardize that trust is, for me, the biggest risk that I face at Hawkeye Wealth. So for me, it became a question around control. Really, I just wanted to be able to control the two main things, which is the product, the deals, and the service. And if I didn't have my own firm, I thought it was just a little bit too much of a risk.
You always
to not
depend on
control the
somebody
experience.
else, right?
Yeah.
Well,
Yeah.
particularly as an exempt dealer, you have the Securities Commission makes you do certain things that by law you have to have. I think they have a way that you have to have the client's interests at heart. You know, they actually have certain terms that they use. You have to have compliance officers to make sure that the clients actually qualify to get into those investments.
Correct. It's very heavily regulated. We have annual audits as well that we have to go through. Not just regular audits, but IFRS audits. They're pretty significant and expensive. But it's important. I think it's the idea of the regulators is they create trust throughout the industry. So I know a lot of people like the fact that there's someone looking out over the firm.
Sure.
And somebody that if we're making recommendations that aren't suitable for our clients, that there's somebody that's checking up on that. So.
But also the client, I mean, not everybody can buy your kind of investments.
Yeah, well, I mean, there's certainly risks in what we do, right? And in any type of real estate, there's risk, especially when there's leverage involved. If you go and you buy the condo next door and you only put 20% down, and the market decreases by 30%, and
Sure.
for whatever reason you had to sell, not only have you lost all your money, you've lost all your money and then some, right?
Yeah.
So, I mean, that's why people join your group, to go and get good information and good research to take as much risk out of that as possible. But when you're doing private equity deals, an added component is the potential lack of liquidity in the deal. So when you invest in one of our deals, the analogy I use is a gondola. You hop on at the bottom and you get off at the top. And if you've gotten off somewhere in between, it probably hasn't been a very good experience for you. So you're in for the duration of the deal, and is that 3 years, is that 5 years, is that 10 years? It can really vary depending on the game plan and what the markets do. So clients have to have a certain amount of wherewithal to be able to go through that lack of liquidity. And the Securities Commission, the way they do this is by ensuring for a number of deals that clients qualify as what they call accredited investors, which is basically a financial wherewithal and sophistication.
So are there
test.
rules that make an accredited investor?
Yes. There's a number of things that can qualify you as an accredited investor. It's not a test or anything like that. The main things that would qualify you as an accredited investor, you don't have to qualify under all three of these, but usually you qualify under one of these three. Would be an income test, so you make $200,000 plus per year, or $300,000 combined with your spouse. You expect to do it this year, and you've made it for the previous 2 years as well. The second test would be the net financial assets test, which would include cash, securities, or a life insurance policy with a cash surrender value. It does not include real estate. So
Right,
if you have, if you
have a $5 million house,
if you had a $5 million house and $3 million in equity, and let's say this was even an investment property, not your principal residence, that still wouldn't count towards net financial assets. So stocks, cash, and life insurance policy with a cash
the government
value.
says, okay, if you have these kind of assets or that kind of income, you should have the wherewithal to make the right decision, right?
Correct. It's a thing around liquidity. What they're concerned about is if you don't have liquidity on your exempt market products that we offer, that you should have liquidity elsewhere. And they've decided that investment real estate is not liquid enough to have the financial
So you said
wherewithal.
multifamily. So you would, how do you pick a multifamily building to represent?
Boy, we really like the value add plays right now. What our overarching belief is we've had an incredible run for the last nearly decade.
Happy ever, yeah.
There has been a lot of money made in real estate over the last decade, and our expectation is that the next 5 to 10 years on the appreciation side isn't going to be as good as the past 5 to 10 years have been. Now, I don't have a crystal ball. I don't know whether that's going to be the case, but that's the overarching belief that we have at Hawkeye. So the question is how do you go and deliver solid returns? And I see a couple of ways to do this, but a big part of it is finding deals where people add the value, not the markets. I think if you're sitting around waiting for the markets to do stuff, I think you're gonna.
You could be right, but more often likely you're going to be wrong.
Yeah, because people as unpredictable and crazy as we are, Ozzie, I think we're more predictable than markets still. So I would say that multifamily in particular, if you can go find an opportunity where there's value to be added, it's been under rented, maybe hasn't had a renovation in a long time. You've got an owner that's a bit out of touch. Maybe they just haven't been. They haven't been paying attention or keeping on top
of it.
Yeah. If you can find those opportunities, what you're able to do is go and bring in experienced management and go and turn that building around, because as you know, multifamily and all commercial assets are priced like businesses, where the more income they produce, the more they're worth. So if you can take an asset that's not producing as much income as it should and turn it around, then you have forced the appreciation on that building regardless of what the market is doing. So whether you're forcing that appreciation through multifamily, or you're doing that through, we do a furnished rental deal as well, where the value add is going and getting way higher rents than you'd be going and getting on an unfurnished.
But you might have some capital investment in the furniture, for instance, or on the upgrades that are needed or something. Not just in the furnished rental, but in everything. Right?
Correct. If you're going to do in a multifamily building, it takes a certain amount of capital outlay to go and do these renovations. And sometimes if you're completely repositioning a building, you have to have a certain amount of capital to go and get the riffraff out of the building and turn it around, right? So certainly it takes a certain amount of capital and more important than the capital, expertise and experience to be good at adding that value.
It's not just the people that live there that maybe you'd attract a different kind of person if they had a washing machine and dryer in their unit, or if they had a renovated unit. It's not just that. You need the expertise in a management team for the property itself. How good are they? What do they know? How much do they care about their tenant pool? It's not just being ready. We have 96% occupancy. If the 96% are all of a quality that bring down the building, and then you have to find the management that actually buys the property. Do they buy well? Don't they pay too much, right? So when you move your investors into those three things, you really have to have an answer for.
Correct. And I think if you're working with the right groups and you're finding these opportunities where you can add value, that's going to make the difference between whether you make a solid return over the next 5 to 10 years, or you just make a return that you get by with. And even more importantly, Ozzie, where the management comes in is if you see a significant downturn, because the way I've always explained it is, you get some experience on the way up, but you get the real education on the way down. So if you can go and find some groups that have seen a few cycles before, I think that's really where you're going to be grateful for groups that have bought right and know how to manage.
Yeah, there's no question about it. But you seem like you enjoy what you do. What do you enjoy the most?
Man, for me, a good deal is like the adult version of show and tell, Ozzie. You have one that comes across your desk, you go and you do your due diligence. When I get one that I'm really excited about, I feel like it's my mission in the world to go and bring it to the people. I mean, I'm not Robin Hood or anything like that. We're in it to make a good living, of course. But I really, really enjoy that. And the other part about real estate that has really attracted me to it over the years, and I didn't know when I first got into this, when you are interested in anything, let's pick any topic of interest, or any kind of common interest, whether it's tennis or real estate or dogs, people get into all sorts of different things. I find that the people that tend to rally around real estate brings together the most wonderful group I've almost seen than any other topic of interest. And I've been grateful for that, because it's not only can you go and get information and meet some wonderful people who are always willing to share what they know, they also have helped me grow a lot as a human. So I think when it comes to real estate, it's really the relationships, and I think real estate's a fantastic area or rallying point for people to get together and
I think once the investor or the novice even understands the principle of the leverage that's involved. You buy that $100,000 property. Yes, you only have $10,000 down, but you have the leverage of the property value increase on the $100,000. If it goes up 10%, you have increased your down payment by 100%. Whereas in the stock market, it could be possible too, but you don't really understand how the company really operates. Whereas in real estate, if you sit down with the property management, yourself as an investment dealer, or the owners, or you get an understanding that, oh, this is how it works. We increase the rent, the gross rent multiplier comes to play, and all of a sudden we have an increase in value. We have options, we can refinance it. All of that without the general market actually changing, but the cap rate, the income changing. And that's what makes it, I guess, that wonderful environment that you talk about. Because once people understand that, they come to our big conferences and they walk away and think, could I do that, right? They start that possibility thinking, no question about it. But there must be challenges. So what are the challenges that you face in your business?
Yeah, well, there are a number of them. I'm really grateful to enjoy what I do. I think one of the toughest things right now is managing expectations. I just said we've had a great run for 5 to 10 years, and thankfully we've done quite well on all the deals we've done with Hawkeye Wealth, and the hard part about that is when you get a deal that let's say you get a deal that returns 10% per annum on your money, and you have a client that's upset that they got 10% of our on their money.
Only 5 times what they got at the bank. Yeah.
It's hard right now. People have done so well that managing expectations is a tough thing to do right now, and thankfully I've gotten a little bit better at managing that. Whenever I onboard a client now, a question I try and ask is, for you, what's a good return?
Sure.
Before we get into the returns on any of the deals we're doing or talk anything about that, for you, if this deal sold and you say, you want to know what, maybe this wasn't a home run return, but this is a good return, what would that number be? And I'm always amazed. About 90% of the clients come back with a number that's between 7 and 12%.
Yeah.
7 and 12%. And I like to set that expectation up first, because when it comes back and you do a deal that, maybe you pro forma it at 15% and it gives them 10%, and then, maybe a couple of years later they're like, oh, I don't know, Justin. And then it allows us to go and say,
sure,
remember when we were going into this, what a good return is? And just
particularly in the last 10 years, we've had returns, particularly in the United States. First of all, you had a 20% return on the currency, depending on when you went in. And then you might have had an operating return of 10 or 15%. So people have been spoiled.
Yes, and you don't want to use the assumptions of the past to predict the assumptions of the future. I just finished saying that I don't think the next 5 years are going to be as good as the previous 5. So why would I use the historical performance to predict the future performance if that's my overarching belief? The hard part that you get is when you use a more conservative pro forma, it's hard to sell. It's hard to sell because everyone's done so well that they're comparing their performance of the past deals they've done with whatever you're putting in front of them here. So it's about resetting expectations, and I think finally clients are coming around to it now, where they're realizing, man, we've had a good run. Let's be grateful for the run that we've had, but let's go and recalibrate on the risks that we're taking on and what our expectations are.
Well, when you take a market like Vancouver, we had sort of a straight up, and then we had a big hiccup. To my mind, that's part of the real estate market. We seem to exaggerate on the upside, and then everybody backs off because they're concerned. And then you read the paper, and then you listen to the radio and the TV, and we stay longer down than we should. But if you look back 50 years, we have really had an incredible run through all the misery of the world, the Russian crisis, the currency crisis, the economic. And so we don't know, as you say, we don't know really what the next 5 years holds. But had you invested in real estate any time in the last 50 years and had a horizon that was beyond tomorrow I need a return, if you can wait 2 or 3 years, you've outperformed the market. So very interesting business that you're in.
If I can share one more thing too that I found that I think is interesting. when you do deals, we don't typically, when we're doing a private equity deal, we do it deal by deal. So if you want to invest, you come into this multifamily building or this industrial building. Our model so far hasn't been to do funds. And another, I don't call it a challenge in this business, but it is a challenge, is if someone were to come into all of our deals, and like I say, thankfully here we've done very well on all of them. But if someone were to come into one of our deals, there's always the possibility that something will go wrong in one of those deals. And there's probably, one or two people that this was the only deal that they did. And that's a challenge of the model too, because in this business, it's way easier not to care, Ozzie. And especially the more you go up the risk spectrum, the less you control the outcome. There's more things that can go wrong. So your options are to either a lot of people just end up numbing themselves. And a lot of people in the business, I say that's another challenge of it, is to stay in the business at the portion of the risk spectrum that we're in. We're certainly not in the very low end of the risk spectrum. We're exposing our clients to some risk. That's a challenge in the business, and to maintain the same level of caring. I don't know if I want to use the word sensitivity because it's got negative connotations, but I'm going to use the word sensitivity to caring about the outcomes is difficult in this business. So if you're working, what I'd say to your listener is, if you're working with someone that you, especially a little bit higher up the risk spectrum, because in the low risk spectrum there's all sorts of people that's easy to care because they're not exposing you to risk. But if you find a little bit higher up the risk spectrum, people still care. You can tell it they're doing their best to have your back. I think that's more rare in this business. If you've got it, hold on to it.
So do you think that's why client decides to work with you?
Well, I hope so. I mean, I don't think we're that unique in the aspect that we are a relationship. Well, we're trust-based business, right, Ozzie? I remember a number of years ago, because I'm trying to ask myself this question all the time: why do clients work with us? And I remember one time, a particular client that was working with my business partner, Mark Gaffo, I was kind of curious, why did they choose to work with Mark? So I asked them, why did you choose to work with Mark? And he said, Justin, Mark's one of those guys that you just want your daughter to marry.
So that's what. So is that the main investment philosophy that drives your decision making?
Well, I mean, I was thinking, maybe if we can hire a whole bunch of people at Hawkeye that you'd feel comfortable having marry into your family, I think we would. Okay. I think we'd be okay. Maybe that'd be part of our interview process, is bring our clients out and have them, tell me whether or not.
You mentioned a number of your investment philosophies. Now I really know the secret of them all. You ask them whether they would marry your daughter.
Well, I think that's why. I think it's mostly why people work. They work because they trust, and the trust is built over time, and that's why I definitely view it as the highest risk part of our business. But of course, we give them opportunities that they might not see elsewhere, and we give them the information they need to make informed decisions. But they don't take that information if they don't trust you.
Well, that's true. Well, what kind of due diligence do you do when you get into a new deal?
It's a long process usually for us, Ozzie. We do it on two sides. We do it on the issuer side. So we work with third parties, Ozzie. We don't do our own deals. So our model is, we find a strategy that we like. We find the group that we believe best executes on that strategy.
So proven record.
Of course. And then even those groups, once we've vetted the groups, then of course on a deal by deal basis, you still have to go and do your due diligence on the deals, right? So first of all, with the groups that we choose to work with, because believe me, there's a lot of people out there that want your listeners' money. There's no lack of people out there that think they have the best deal for you. So our job, and we get contacted on a weekly basis with groups that want to work with us, Ozzie. What we usually do is try and weed them out as fast as possible. Are they executing on a strategy we like? If it's not, out. It's just not interested, unless it's a killer group that we think might later execute on a strategy that we like. What has been their past performance and their track record? What's their reputation in the industry? It's a small world we live in, Ozzie. If there's a new group that I meet the chances that you or a couple other people that are very well connected in this business know this group and can tell me something about them and whether they would do business with them is pretty high, especially here in Vancouver and on the West Coast. Toronto's a little bit bigger, a little bit harder, maybe the US as well, but small world here. So we go and we ask around, right? One of my personal favorites is when issuers call us and they need money right away. One of my instinctual response to them is, well, I'm not going to be able to help you on this deal.
No.
But maybe we should grab a coffee here sometime and see if maybe over the next year or two we might be able to work together.
Yeah, because any time that waits till the last minute, or who backed away from that deal at the last minute, or did you really leave it this long? What's wrong?
So and if they're not willing to plant a long-term seed, if they're not willing to plant a long-term seed, then I'm a long-term guy. Then if they're not willing to get together for coffee, knowing that we might do a lot of business a year or 2, 3 down the road, then that's just not the mindset. That's not the culture. That's just it's a pretty good indicator that you're not the one for me. So a lot of our due diligence is based around the issuers, right? And these questions and a few others we ask eliminate 90+% of the groups that approach us, because otherwise
I think that's what your clients want. They want you to take a good hard look at who operates it. If they had the time or the wherewithal or the know-how to do it themselves, they would. So once you've established trust, that's what they expect from you to do, no question about it. Well, look, with all the things that are going on in this world, of course, depending on when you listen to this world means it's September of 2019, so that we're in the middle of having seen a huge turnaround in interest rate structures around the world. There's forecasts of the world going into a recession and all sorts of things going on. What investment strategies do you like right now?
We're still heavily involved in multifamily in the US, with the greater opportunity to add value, the better. It certainly wouldn't be a time that we're going into Class A in many markets in the US. I just think there's a little bit too much uncertainty. I'd rather count on proven models of value add, and in many ways, and a lot of veteran investors make the argument that workforce housing in the US is almost the new core, and in many ways less risky than your downtown Class A assets, just because of that value add component and the fact that the replacement cost. You can't build new supply at the same price we're buying this at. So when it comes to the rents that you can afford to charge, a lot lower rents than many of the new buildings that are being bought. So we still really like workforce housing in the U.S. and of
so
course
you need to know what is the population. Are people moving there? Is Microsoft moving its plant or something? Do you have to study a local market area? I always preach that values go where people go, and people go where the jobs are. So very, very important that is studied, and saying the building might be right and the price might be right, but everybody is leaving, right? There's a reason why in Shell Lake, Saskatchewan, a building lot is only $1. The reason is people are leaving Shell Lake, right? So, and anyways, point is, so the investment strategies you look like right now are the United States. And
like multifamily in the U.S., also like industrial locally here in the Lower Mainland. We don't like much else in the Lower Mainland here as of September 2019. Let's go and timestamp it again. For a few reasons, it's very difficult to get cash flow in any asset class, and actually industrial doesn't even break the mold in terms of.
Well, prices have gone up so dramatically the last 2 or 3 years.
And it's hard to know what even the industrial market. It's hard to know what it's going to do in the next 2, 3, 4 years. But what we do know is that there is a serious shortage of land available to build out industrial properties. Over the decades, many cities have pulled land out of industrial zoning and turned it into residential, just to go and build more housing units. And what that means is there's been a lot of research done on the topic here, but we estimate that they're going to be out of industrial land in the Lower Mainland within the next 10 years.
Sure.
And it's not like residential where you just build up. We just need to go and do 30-story industrial. The logistics issues around.
Can't drive that truck up to the 10th floor.
Yeah, and they're trying. I mean, there's a couple projects going on that are proposing, two, 3 stories, because it's going to get there eventually, but it's very difficult and expensive to do.
Right.
So what we believe is there might be some volatility over the next few years. Maybe it's one of those feast before the famine situations where there's a whole bunch of supply built out over 2, 3, 4, 5 years while there's still land available. Everybody's building and maybe their vacancies creep up. We got the lowest vacancies in North America in industrial right now.
Yeah.
But if you're able to hold on to that property, eventually you'll be in a situation where there's just no land left.
Well, and most cities in Canada have land that they expand in all directions, whereas in the lower mainland we got the ocean, we got the mountains, and we got the U.S. border. So there's only so much land available.
You're right, and a lot of warehousing, for example, doesn't want to go too far east because they want to be able to deliver within. It's in this world where you want to click and have it at your doorstep 3 seconds later.
And you need transportation, orientation, all that. Okay, well, we know what your strategies are. What are you shying away from?
Well, for all the reasons that we're moving towards industrial, we're shying away from retail. Not that I necessarily believe it's going to die anytime soon. It's just when you've got all these different options available, it's not about is it a bad option. It's what the question you're asking is what's the best.
Yeah.
What are the best options, right? And with the change in the way people are shopping, it's
sure, online.
It's going towards e-commerce, and I usually bring this comment up as well. My wife is from Shanghai, and I'm in Shanghai almost yearly, and I'm amazed at how much more rapidly they've adopted online shopping. And what I've concluded is that a big part of that is that they've got a much lower cost of delivery in China for 2 reasons. They've got density. It's high rise. Everybody lives in condos. So you've got density, which means you don't have to travel as far to deliver things. And then you've got a low cost of labor. You've got scooters and bikes and just ripping around everywhere delivering stuff all day long. And everyone has Amazon, or it's not actually Amazon that most people use in China, but there's storage lockers that deliver it right to you. So in China, when I go to the malls, you'll be amazed how quiet many of them are. In the middle of Shanghai, these aren't ghost cities. These are, very.
Well, you look in the United States. I did a little blurb in OZZIE'S last week where some 6,000 stores have closed in 2017, another 3,800 in 2018. So clearly, if you're in a mall and the next door neighbor closes and the other one closes, all of a sudden fewer people come. 1,100 malls altogether have shut down last year. So clearly, that's why I say the online delivery now needs maybe downtown storage. So maybe there's some industrial warehouse space. Actually, downtown you need, if it's overnight, you can't really be 50 miles away, or there's costs attached. And the drones are going to maybe a while off before they can deliver.
Yeah, well, the technology, the drones are maybe still a little ways out, but the delivery robots are pretty much here, and that's what the great equalizer. I think they're a little bit ahead of us in China, but I think what the great equalizer here for us, because we don't have density, we don't have low costs of labor. We have low density, high cost of labor, but robots can solve that. They don't cost much. They're pretty low maintenance that way, and they can travel some distance. So yeah, we remain very excited. The argument that a lot of people make for retail, and I want to say it makes me laugh because I don't want to say I laugh, but the argument is, well, look at all these things look at all these retail shops, the dentists and all these that are never going to be able to, that are never going to go online, right? You can't get your teeth done online, because that's the argument a lot of people make for retail, right? And the point isn't, are there not going to be some businesses that still need a place to set up shop? The point is, if you have a certain subsection of these businesses, let's call it 10% of them that are getting replaced by e-commerce, what does that do to vacancy rates?
Sure.
It moves them. So you might still have 9 of the 10 businesses that you had 5 years ago still in business, but those 1-2 businesses that have gone out, you've now got 10, 20, 30% vacancies in your units. And what happens to your rental rates?
Yeah. So clearly the retail market is very dangerous.
I spend a lot of time talking about how much I don't like the retail market, it's
there's no question. But the point is, your clients will know that too, and how you feel. Do you have any last few words for for the markets in general? How do you see the future and potential clients?
I would say now is a great time to recalibrate your expectations in terms of what you should be expecting for performance. Recalibrate for the assumptions that you're using when you're going and doing due diligence and running your pro formas. I would say now is a time to be patient, and I don't say this as an excuse not to take action. We should always be taking action, but be prepared when you're making decisions to be in these things for a while right now, because I really don't believe the markets are going to be for the next 5 years what they've been for the previous 5. So be patient. I think along with you that long-term real estate is the place to be, and we're always excited, as I said, when we've got a new deal to go and show and tell it to you and your listeners. So if there's anything we can ever do to help, we're here.
Well, you see, the world's now going maybe towards 0% interest rates, so maybe 10% is going to look just wonderfully a few years from now. Justin, thank you so much for taking the time out of your hectic schedule and join us at OZZIE'S. Anybody that wants to see you, what's your website address?
Yeah, our website is hawkeyewealth.com. Again, that's hawkeyewealth.com, or if anybody wants to reach out to me personally, I'm Justin at hawkeyewealth.com.
Sounds good. Thank you very much for coming.
Thank you, Ozzie.